If you've spent any time watching the market, you've probably noticed it behaves a lot like a living creature, breathing, expanding, contracting, reacting. Now, before we get too deep, let me briefly remind you how today's topic connects with something we discussed in the previous video on the top 3 composite man secrets every trader must know, because understanding the forces behind the tape will help you understand the very structure of the market itself. You see, the stock market, at its core, is simply a giant auction, nothing mystical, nothing magical, an auction where buyers and sellers negotiate price moment by moment. But have you ever stopped and asked yourself who is really influencing those price swings? Because if you've wondered that, you're already thinking like a trader instead of a spectator. When I first studied the market decades ago, I realized most beginners try to interpret price action as if it were random. They chase tips, they rely on hope, they treat the market like a lottery. But the market rewards those who observe, measure, and understand the motives behind the moves. Isn't that a more grounded way to think about participating in this great mechanism of commerce? The first thing a new student must grasp is supply and demand, not as dry textbook concepts, but as living forces you can see on a chart. When demand is dominant, prices rise. When supply takes control, prices fall. Straightforward, isn't it? Yet many traders forget to ask the essential question: why is supply showing up here? Why is demand disappearing there? These questions open the door to reading the intentions of the large operators, the very ones I often describe as the composite man. As you begin your journey, picture each chart as a story. Each bar, each swing, each volume spike is a clue. So ask yourself, what story is this chart trying to tell me right now? If a stock moves up on weak volume, for example, you might suspect the public is doing more of the lifting than the professionals. If it shakes out sharply before rising, that might be deliberate. An operation meant to free the market from weak holders. Doesn't it feel more empowering when you can interpret the action rather than simply react to it? Most beginners enter the market with the wrong expectations. They want quick gains with little study. But the operator who survives and grows is the one who develops a calm relationship with risk. You don't approach the market with desperation. You approach it with curiosity and discipline. Have you noticed how your own mindset changes the way you trade? A rushed and fearful trader sees every dip as danger, while a trained and patient trader sees it as an opportunity to observe the footprints of supply and demand. Now, as we explore how the market works, remember that accumulation and distribution form the backbone of all price campaigns. When large operators accumulate, the stock tends to move sideways while volume tells the real story. Beginners often miss this because the price isn't doing much. But let me ask you, isn't it true that some of the most powerful movements begin in periods where very little seems to be happening? This is where reading the tape becomes less about excitement and more about subtlety. And this ties back, naturally, to what we discussed about the composite man in that previous video. Today's principles become clearer when you recall that everything on the chart can be interpreted as part of his plan. When you see a sudden shakeout or a long period of dullness, doesn't it make more sense if you imagine a single skilled operator preparing the next phase? Let's talk about beginners recognizing structure. The market moves in phases: accumulation, markup, distribution, markdown. Each phase has its own behavior, its own personality, its own tell. For instance, during accumulation you'll often spot springs, tests, and light volume pullbacks. In markup, you'll see surges in price followed by orderly reactions. Ask yourself again, which phase is the stock in right now? Because knowing that alone can keep you from fighting the tide. One of the most valuable money mindset lessons I learned early on was this: you are not required to take every trade. In fact, doing less, while understanding more, is one of the marks of a maturing operator. Have you ever felt the urge to jump into a setup just because it moved quickly without you? That feeling is dangerous. The composite man relies on that kind of impatience. A wise trader waits, watches, studies, and enters only when the market shows its hand. As you grow in this craft, you'll see that wealth building in trading is not about constant action. It's about aligning yourself with high-quality movements and avoiding unnecessary losses. Slow, steady compounding is far more reliable than chasing excitement. Think about it. Isn't a controlled, thought-out campaign better than a frantic series of guesses? Another essential aspect for beginners is volume. Price might lie, but volume rarely does. When you see price rising but volume shrinking, you must question the strength behind the move. When you see a test on low volume, that can signal the exhaustion of supply. And if you see a wide spread-down candle closing well off the lows on heavy volume, ask yourself, is this true selling or a trap to shake out the inexperienced? Your ability to ask the right questions is what transforms chart reading from confusion into clarity. Trading is also about emotional balance. Many newcomers assume professionals feel nothing, no fear, no hesitation. But that is not true. Even experienced operators feel the pull of emotion. The difference is they have trained their reactions. They recognize that fear during accumulation and greed during distribution are the traps that lead the public astray. Have you ever noticed how your emotions seem strongest right before the market proves you wrong? That is not coincidence, it is part of the mechanism. The market is designed to test you, to measure your resolve, to reward those who observe and punish those who assume. That's why it's important to study the chart as if you were studying human behavior. Because, in a way, you are. The market reflects the crowd's emotion, the professional's intentions, and your own mindset back at you, every minute of every session. As you move deeper into this world, remember that you don't need to predict, you need to interpret. You don't need to be perfect, you need to be consistent. Ask yourself often, am I trading what I see, or what I hope to see? That single question can save you from countless avoidable losses. When we say the stock market functions as a continuous auction driven by supply and demand, most beginners immediately picture something abstract. Numbers moving on a screen, prices bouncing up and down, and tickers flashing by. But if you slow down and look at the market through the eyes of a trained operator, you'll notice that everything happening on that screen is simply the result of buyers and sellers negotiating value in real time. It's no different from an auction floor, except the bids and offers are expressed through price movement rather than shouted across a room. And if you think about it, isn't it easier to understand the market when you stop treating it like a mystery and start seeing it as a straightforward negotiation? Imagine you're standing at an old-style auction. An item is presented. The auctioneer calls for bids. If many people want the item, the bids rise quickly. If very few want it, the price struggles to move. The stock market works on this exact same principle. When demand exceeds supply, prices rise. When supply outweighs demand, prices fall. It's simple, almost deceptively simple. Yet traders often forget this foundation while getting caught up in indicators, news events, or predictions. So ask yourself, if all price movement reflects supply and demand, shouldn't that be the first thing you study? The beauty of this principle is that it gives you a reliable lens to interpret the market. You're no longer guessing why a price moved. You're observing who was dominant in the negotiation. When you see the price lifting upward with wide spreads and strong volume, you're witnessing demand taking charge. When you see sharp declines with heavy volume, that's supply showing its muscle. Once you train your eye to spot these shifts, you begin to read the market the way an auctioneer reads a room. And doesn't it feel more grounded when you focus on something measurable instead of relying on speculation? Now, beginners often ask, but who creates this supply and demand? Isn't it just random people buying stocks? The truth is, not all bidders in the auction are equal. Just as a wealthy buyer in a traditional auction can move the bidding more dramatically than a crowd of small bidders, large institutional operators have far more influence on the market than thousands of small retail traders combined. This is why understanding supply and demand naturally leads you to understanding the behavior of these large operators. Their buying increases demand. Their selling increases supply. Their campaigns create trends. Once you grasp this, you begin to see charts not as chaotic lines, but as the footprints of powerful participants managing their operations. But here's the part many beginners missed: supply and demand are not just visible in the direction of price, they're visible in how price moves. A slow, creeping rise on low volume tells you demand is present but not enthusiastic. A sudden surge upward on strong volume signals committed buying. A sideways range after a large decline might mean supply is still being unloaded, even if price isn't falling dramatically. Every bar is a clue, every volume spike a message. So let me ask you directly, when you look at a chart, are you watching passively, or are you actively searching for these signs? As you deepen your understanding of the market as an auction, you begin to see why predicting the future isn't necessary. You don't need to know where the price will be next week. You only need to understand whether demand or supply is currently dominant. If demand is persistent and supply is weak, the path of least resistance is upward. If supply is overwhelming demand, the path is downward. This doesn't require forecasting, it requires observation. Doesn't it feel more achievable to observe what is happening rather than guess what will happen? And this is where the mindset of a trader begins to evolve. Instead of feeling lost, pressured, or impulsive, you start feeling curious. You begin asking rational questions. Who is in control at this moment? Are buyers eager or hesitant? Is supply increasing or drying up? These questions keep you grounded, and they keep you from falling into emotional traps. Many beginners panic when the market dips or rush in when it spikes. But an operator who understands supply and demand knows those movements are simply shifts in the auction, not personal attacks or lucky breaks. Another important point is that supply and demand operate on every time frame. Whether you're looking at a 1-minute chart or a weekly chart, the same relationship governs the movement. On a small scale, short bursts of demand may push price upward for minutes or hours. On a larger scale, sustained accumulation by institutions can fuel months-long uptrends. This consistency is what makes the auction model so powerful. It doesn't change based on time frame, strategy, or market conditions. So ask yourself again if this principle is constant. Shouldn't it be the foundation of your trading approach? Once you start interpreting the market this way, you'll find that your decisions become cleaner. You're not trading because someone on social media mentioned a stock. You're not buying because the price looks low. You're basing your actions on measurable evidence of supply and demand. You're aligning with the dominant side of the auction. And that alignment is what separates those who struggle from those who learn to operate with clarity and confidence. When you realize that price movements reflect the intentions of large operators more than the actions of the public, the entire market begins to make sense in a way most beginners never experience. At first glance, it's tempting to believe that millions of small traders buying and selling are what move prices each day. It feels intuitive, especially when you imagine how many people participate in the markets. But if you pause and really think about the mechanics, doesn't it seem far more likely that entities with deep capital, strategic planning, and long-term objectives would have a greater influence on price than a crowd acting randomly and emotionally? Large operators, institutions, funds, and professional syndicates don't approach the market the way the average person does. They don't chase breakouts impulsively. They don't panic on dips. They don't rely on feelings or guesswork. Their moves are intentional, structured, and methodical. And because they operate with significant capital, their buying and selling leaves footprints you can learn to recognize on a chart. So ask yourself if you could interpret these footprints. Wouldn't that give you a clearer understanding of what's truly happening behind the scenes? One of the biggest mistakes beginners make is attributing sudden spikes, deep pullbacks, or drawn-out ranges to random fluctuations. But the market rarely moves randomly. A sharp markup often points to aggressive demand from operators preparing for a larger campaign. A sudden shakeout might be an operation designed to remove weak holders. A long, quiet range can signal accumulation or distribution, depending on subtle shifts in volume and price behavior. These shifts don't happen by accident. They happen because the large operators are positioning themselves. Once you learn to observe their behavior, instead of reacting to noise, your trading starts to calm down, doesn't it? Think for a moment about how institutions must operate. When they want to buy a large quantity of shares, they can't simply enter the market and hit the buy button all at once. Doing so would send the price soaring instantly, costing them more and alerting everyone to their intentions. Instead, they must accumulate gradually, often over days, weeks, or even months. This slow, steady absorption of supply creates subtle signs on the chart: higher lows, controlled pullbacks, tests on low volume. Most retail traders overlook these signs because they're too focused on dramatic movements. But have you ever noticed how the biggest moves often come after long periods where the market seems quiet or dull? The same logic applies to selling. Large operators can't dump millions of shares at once. The price would collapse. Instead, they distribute gradually, selling into strength, encouraging public participation, and creating the illusion of ongoing demand. This phase often shows up as choppy, overlapping price action with heavy volume on rallies and lighter volume on declines. Beginners often interpret this as a market that's taking a breather, but trained operators view it as a sign that supply is increasing. So let me ask you, the last time you saw a stock struggling to push higher despite good news, did you consider the possibility that distribution was underway? Understanding the intentions of large operators means shifting your mindset from prediction to interpretation. Instead of trying to guess where the price will go, you learn to observe what the dominant forces are doing right now. If they're absorbing supply quietly, you don't need to predict a rally. You simply recognize accumulation. If they're unloading into strength, you don't need to fear missing out on the final move up. You recognize distribution. This clarity removes a great deal of emotional noise. It helps you stay focused on the market's behavior rather than your own reactions. Another important aspect is volume. The public alone cannot generate sustained high volume activity. When you see a surge in volume, it usually means the professionals are active. But the key is understanding how that volume behaves. High volume on a decline may show panic selling from the public, yet the close of the bar tells you whether operators stepped in to absorb that supply. A wide spread down that closes near the middle or high can reveal hidden strength. Have you ever noticed how some declines seem violent at first glance, yet the price refuses to follow through downward afterward? That is often the signature of operator absorption. Conversely, when you see price rising rapidly but volume shrinking, it's a clue that operators may not be participating in the move. Without their support, such rallies often fail. This is why the public so often buys near tops. They are reacting emotionally to rising prices, while operators quietly step aside or sell into the enthusiasm. If you've ever bought a stock because it looks strong, only to watch it reverse immediately, you've likely experienced the aftermath of operator distribution. Another thing to consider is intention. Large operators don't trade for short-term thrill or excitement. They build campaigns. They analyze conditions. They manage risk. Their buying usually signals preparation for a significant markup, not a quick flip. Their selling often marks the end of a campaign, not a sudden shift in mood. If you adopt this mindset, you start trading with patience and purpose instead of urgency. Isn't that a calmer, more logical approach? The real power comes when you begin to anticipate the behavior of large operators based on the structure of the market. Accumulation tends to lead to markup. Distribution tends to lead to markdown. Springs, tests, upthrusts, shakeouts. These are all part of the operator's toolkit, the strategic maneuvers they use to position themselves advantageously. When you see these patterns not as random events but as deliberate actions, the market feels less chaotic and more like a narrative unfolding in front of you. When we say that volume reveals the true strength behind price behavior, it may sound simple at first, but understanding it in depth is one of the most powerful tools a trader can possess. Many beginners focus almost exclusively on the direction of the price, thinking that if a stock is moving up, it must be strong, and if it's moving down, it must be weak. But price without context is like reading a sentence with missing words. Volume provides that context. It tells you whether the move is backed by real participation or if it's merely a fleeting illusion. Have you ever noticed a stock pushing higher while very few shares are actually trading? That's often a warning sign rather than a signal of strength. Volume is, in essence, a measure of activity, but more than that, it is a measure of commitment. When you see a price move accompanied by significant volume, you know that a large number of participants are actively engaging in the market at that level. And it's not just the quantity of volume that matters, it's the timing and the relation to price movement. A wide upward bar on high volume usually signals strong buying interest, whereas a similar price move on low volume may indicate that only a few eager buyers are present and that the move could easily reverse. Ask yourself, wouldn't it be more reliable to observe how many traders are actually behind a move than to trust the move itself blindly? Volume also provides clues about the intentions of the large operators who dominate the market. The price alone does not reveal whether a move is being driven by smart money or by public enthusiasm. When price rises on heavy volume, it often means that professionals are absorbing shares from the weaker hands, gradually accumulating for a larger campaign. When price declines on heavy volume, it may indicate that they are distributing, selling into public enthusiasm while shaking out weaker traders. Conversely, when a price movement occurs on light volume, it often represents the activity of the public rather than the intentions of informed operators. Recognizing these patterns allows you to see beyond the surface and understand the true narrative behind the market's actions. Beginners frequently misinterpret low volume moves, thinking that they signal strength or weakness on their own. But context is everything. Consider a stock that breaks above a resistance level with very low volume. The public may view this as a breakout, but an experienced operator recognizes that without significant participation, the move lacks sustainability. It's like trying to lift a heavy object with only a few hands. Without coordinated effort, the object won't move far. Similarly, price moves without volume backing are often short-lived, vulnerable to reversal once professional operators choose to act. Isn't it fascinating how understanding this can prevent you from being trapped in false moves? Another important concept is the idea of testing. Operators frequently test the market by creating small moves on lower volume to gauge whether supply or demand is still present. For example, a pullback on light volume during an uptrend often indicates that selling pressure is minimal and the trend is likely to resume. Conversely, an advance on low volume may be a test to see whether buyers are willing to participate at higher prices. Recognizing these subtle clues can give you an edge, because you are no longer relying on price alone, you are interpreting the intent behind each movement. Volume also becomes crucial when evaluating consolidation periods. Stocks rarely move in a straight line. They pause, range, and consolidate. During these phases, volume can reveal whether accumulation or distribution is taking place. For instance, during a sideways range, increasing volume on small upward moves can indicate accumulation by informed operators, while increasing volume on small downward moves may suggest distribution. A casual observer might see only indecision, but a trained eye sees the invisible hands shaping the next move. Have you ever wondered why some stocks seem to come alive after a period of apparent boredom? Volume holds the answer. Patterns such as springs, shakeouts, upthrusts, and tests are all intimately connected to volume. A spring during accumulation typically shows a brief decline on higher volume, followed by a strong recovery, signaling that operators are absorbing supply and trapping weak holders. An upthrust in distribution shows a sudden rally on increased volume that fails to hold, indicating that the smart money is selling into enthusiasm. Without reading volume, these maneuvers are nearly invisible to the untrained eye. Do you see how much more clarity this gives you when interpreting the chart? Volume also serves as a confirmation tool. A price breakout, no matter how visually impressive, is far more credible when volume aligns with the move. Conversely, divergence between price and volume is a warning. For example, rising price with declining volume often foreshadows a potential reversal, as the market lacks the conviction needed to sustain the trend. Similarly, falling price on declining volume might suggest that selling pressure is drying up, setting the stage for a potential rally. Once you begin to interpret volume in this way, your ability to anticipate and understand market behavior deepens significantly. Ultimately, volume tells the story of participation, conviction, and intent. Price alone is like the headline, but volume is the body of the article. It explains why the move happened, who is behind it, and how likely it is to continue. Without volume, price is a flat number devoid of meaning. With volume, every bar, every spike, every pullback becomes part of a coherent narrative you can read, interpret, and act upon. When we discuss accumulation and distribution phases as the backbone of all price campaigns, it's essential to understand that these are not abstract concepts. They are the structural foundation upon which all market moves are built. Beginners often look at a chart and see only zigzags and swings, thinking that markets rise and fall randomly. But an experienced operator sees a different picture. Periods of quiet absorption followed by explosive moves, and periods of methodical selling followed by declines. Ask yourself this: if the same principles govern nearly every major trend in the market, wouldn't it make sense to study these phases carefully instead of reacting to each move as if it were unique? Accumulation is the phase where large operators are quietly buying shares from the public. The price may appear to be moving sideways or even showing minor declines, but in reality, informed buying is slowly building a position in anticipation of a future markup. The key for a beginner is to recognize that accumulation is deliberate and methodical. Large operators cannot risk pushing the price too high too quickly, or they will alert the public and pay more than necessary. So instead, they operate in a way that masks their activity, using tests, springs, and light volume pullbacks to gauge supply. Have you ever noticed a stock that seemed stagnant for weeks or months, only to suddenly surge without warning? That's often the culmination of a long accumulation phase. Distribution, on the other hand, is the opposite process. Here, large operators are selling shares into public enthusiasm. The price may be rising or appear stable, but the smart money is gradually unloading positions. Distribution is often disguised by seemingly bullish activity, minor rallies, overlapping price bars, and false breakouts. Beginners who are unaware of distribution often buy near the top, assuming that the upward trend will continue indefinitely. But when you understand that accumulation and distribution are mirrored processes, it becomes clear that what goes up can also come down once the operators have completed their campaign. Does it surprise you how often markets reverse precisely after these carefully orchestrated distribution phases? Recognizing these phases requires more than just observing price. It requires understanding volume, spreads, and testing patterns. During accumulation, for example, a spring or a shakeout will often occur. The price dips below a prior support level, triggering weak holders to sell, and the large operators quietly absorb the shares. Volume in these dips is key. It should confirm that strong hands are stepping in to take the supply. During distribution, similar moves happen in reverse. Price rallies on heavy volume as operators sell into demand, trapping late buyers and creating a scenario where the next move is likely downward. Are you beginning to see how each phase tells a story of intention behind the chart? Another critical point is that these phases are rarely instantaneous. Accumulation can take weeks, months, or even years, depending on the liquidity and size of the position being built. Distribution follows a similar timeline, carefully unloading without alarming the market. Patience is essential for both the operator and the student trying to understand the market. Many beginners expect rapid gains or dramatic signals, but the most reliable trading opportunities come from observing these slow, deliberate campaigns. Isn't it more effective to wait and study the market's structure than to chase quick profits in a chaotic environment? The phases also provide context for interpreting market psychology. During accumulation, the public is often pessimistic, unaware that the professionals are quietly building positions. This negativity creates a supply of shares for the operators to absorb. During distribution, the public is often euphoric, buying into rallies that appear strong, unaware that they are absorbing shares from the professionals who are selling. Understanding these behavioral dynamics is vital because it allows you to see that market moves are not random. They are the product of both human psychology and strategic planning. Have you ever considered that your own reactions as a trader often mirror the public sentiment during these phases? Patterns within these phases further reinforce their importance. Springs, tests, upthrusts, and shakeouts all occur as part of accumulation and distribution, signaling potential continuation or reversal. A successful trader learns to identify these patterns and interpret them correctly. During accumulation, a test on low volume may indicate that supply is exhausted and the stage is set for a markup. During distribution, an upthrust may indicate that demand is ending and a markdown is imminent. Volume, bar structure, and context combine to create a roadmap that reveals what the market is truly doing. Isn't it remarkable how much insight a careful study of these phases can provide compared to simply following the price line? Finally, understanding accumulation and distribution ties directly into the broader principles of money management and trading psychology. Traders who grasp these phases approach the market with patience, discipline, and clarity. They do not feel pressured to enter every move or fear missing out on rapid swings. Instead, they wait for confirmation, align with dominant forces, and respect the campaigns unfolding behind the scenes. This approach is far more sustainable than impulsive trading based solely on price action.